Car finance comes in several varieties. It is important to understand the features of each and whether they would be suitable for you before looking at quotes. There are two main types of car finance: hire purchase and personal contract purchase. Remember, there are other sources of finance also, such as personal loans, which are detailed in the Sources of Finance video. What all car finance has in common is that the loan is secured on your car, meaning that you do not own the car until you've repaid the finance in full. You cannot sell or modify the car without the lender's permission. The lender can repossess your car to put towards your repayments if you fail to make repayments when due. This is an automatic right until you have made 1/3 of the total repayments. After that point, the lender can only repossess your car with a court order. First, we look at PCP, or Personal Contract Purchase. There are two key features. Part of the loan amount is deferred to the end of the loan term, called the Guaranteed Minimum Future Value. This means your monthly repayments are smaller as you do not pay off the full cost of the car during the term of the loan. At the end of the loan, you can either return your car and walk away with nothing further to pay, or if your car is worth more than the balancing loan payment, you can sell or part exchange it and keep any amount in excess of the finance settlement. Or you can pay the balancing loan payment and keep the car. However, you need to be aware of some of the restrictions with PCP. You must decide upfront a maximum annual mileage, and if you exceed this, you'll be charged. You must return the car in good condition, with servicing and maintenance completed when due, and if this is not the case, you could be charged. PCP is only available on new or nearly new cars. The total cost of borrowing is greater than for hire purchase, since you are paying interest on a larger balance, and therefore if you want to own the car outright, hire purchase would usually be cheaper. At the end of the loan, you are likely to require finance in order to afford another car, and unlikely to have much deposit available from the Part X of your car, since most or all of that part exchange value will go to the lender to pay off your loan. So let's look at an example. For PCP, you decide the length of the loan and the number of miles per year. The lender then calculates the future car value and monthly payments, which are based on the car value, the amount borrowed, your income, credit rating, and personal circumstances. At the end of the loan term, you have the option to buy the car, part exchange the car, or return the car. You must ensure you keep to the conditions agreed to avoid being charged. PCP may be suitable for those who need low monthly repayment amounts, who plan to replace their car every 2 to 4 years with new or nearly new cars, who do not wish to own the vehicle outright, or who plan to continue purchasing cars using finance or expecting a significant future income that you could put towards the balancing loan payment, and if you want protection against unexpectedly severe depreciation. Next, we look at hire purchase. The key features are that the finance is repaid in full over an agreed term of the loan, and this means monthly repayments are higher than PCP since you are paying back the loan in full rather than leaving a balance to the end of the loan term. At the end of the loan term, the car is yours. You can either keep it or sell it to put towards another car. Any sale amount is yours in full, which differs from PCP, where most or all of this would be used to pay off the remaining finance. The total interest cost is cheaper than PCP since you're paying down the loan quicker. There are no mileage restrictions. Hire purchase can be used to finance older cars, unlike PCP, which is mainly for new or nearly new cars. So let's look at an example. For hire purchase, you decide the length of the loan. You don't need to set a maximum mileage. The lender calculates the monthly payments, similar to PCP, but in this case the full value of the car is included in the monthly payments. At the end of the loan term, you own the car. Hire purchase may be suitable for those who wish to own the vehicle at the end of the finance period, or be able to use the full value of the vehicle as part exchange towards another car. If you plan to keep the car for a long period, if you do not want mileage restrictions, and if you are buying a new car and can afford the higher repayment amounts, or you're buying an older car where PCP is not available. Here we compare PCP and hire purchase side by side. Hire purchase is available for new, nearly new and used cars. PCP is only suitable if you will replace your car every 2 to 4 years. Hire purchase is suitable for long and short-term car ownership. PCP has lower monthly payment amounts, but a higher overall interest cost. PCP provides some protection from unexpected depreciation, and hire purchase does not have mileage limitations. If you'd like to know more, then see our website or get in touch with one of the team at Motor Pocket.